So this is really just repetition. It's still going to be very worthwhile for you to hear it again if you've already heard it, because the implementation date again is here, and it's time for us all to take this seriously and go ahead and start looking at the implementation, the impact on our individual entities and organizations. So with that said, I'm going to shut off my camera now that I've done an intro, and let you all focus on the slides as I go through them here. I have a call at 1, so I got to jump off promptly. But if time allows, I tend to be very long-winded, as anyone on here that knows me is aware. So I'll try to leave some time for Q&A at the end. But if we don't get there, here's my information. Jeremy Shin, our marketing director here at YHB, will be sending out, I believe, the recording along with the slide deck at the close of this presentation. So again, if we don't get to Q&A, please reach out. More than happy to jump on a call with anyone on the presentation today. So the basics of ASC 842 and ultimately why this matters. You all probably saw in the short description in the email for registration that the intended users really at the end of the day are going to be folks that have GAAP basis financial statements. So you either have a financial relationship, a credit relationship, whether that's with a bank, a surety, or the users of your state, other users of your statements being owners, investors, require a GAAP basis financial statement. That is who this is going to be applicable to, as well as credit analysts. So those surety underwriters, those lenders, credit analysts, that are going to be looking at these GAAP basis financial statements. It's going to be very important for them to understand the impact of this new leasing standard on the balance sheet of their clients. It is going to have a significant impact, potentially a significant impact at the end of the day on net working capital and debt to equity. Two very relevant ratios that are used in most credit analysis. So we will get to that at the end with the presentation and disclosures. So to start, the basics. Is this applicable to me and my organization? At the end of the day, if you have a real estate lease, vehicle leases, those are the most common, right, that we're going to run into. At the end of the day, yes, there's copier leases, and there's some of these immaterial, for lack of a better term, leases, and we'll discuss that a little bit further and how that potentially is going to impact you. But at the end of the day, keep in mind that when you're having these discussions with your independent CPA, that materiality does come into play. However, all leases, with the exception of those listed that you see here, this is going to apply to them. And it applies to all entities, not-for-profit organizations, for-profit organizations. It's applicable. So it is coming. All remaining leases will have a right of use asset and a lease liability that come onto the balance sheet. And we'll dig a little bit more into that term, right of use asset, lease liability. Those are going to be two terms that you are going to become very familiar with this standard and moving forward. They will be on the face of your balance sheet. In terms of the timeline, Matt, why are they doing this to us? Why is FASB blowing up what was a good thing with the old standard, which was ASC 840? ASC 840, the old leasing standard, it required you to evaluate capital leases. In capital leases, you would have to capitalize and put on the face of the balance sheet. That's not really changing. That's still there. They're called financing leases now, not capital leases, but it's the same thing. What this is doing is it's taking your operating leases, those real estate leases, and bringing them onto the face of your balance sheet. The initial exposure draft came out back in 2013. At the end of the day, fortunately or unfortunately, depending on how you want to look at it, most of these standards changes are the result of public companies and the SEC's analysis of public company statements and risk. And they ultimately determined that operating leases are a form of off-balance sheet financing. So in order to provide better transparency to users of the statements, the owners, the investors, the lenders, the underwriters, that it made sense to bring these operating leases, which have always been in the footnotes, into the light more and put them on the face of the balance sheet. It's ultimately what it's getting to. They said that better financial transparency for off-balance sheet arrangements. So you fast forward, the can's been kicked down the road several times. The implementation initially, I believe, was set back about 3 years ago. They pushed it a year, then the pandemic hit, they pushed it again. Public entities had to implement this back with calendar year ends beginning 12th or calendar year ends December 31st, 2019. For private companies, which are most likely everyone on the call today, this is applicable now for year ends beginning after December 15th, 2021. It's a very weird way that FASB likes to say, starting with your year ends 12/31/2022. If you're a fiscal year end client of say a 6/30, you are going to get to kick that can a little further, of course, down to 6/30/2023. So it's year ends starting with 12/31/2022 this year. This is applicable and has to be implemented in order to say that you have a GAAP basis financial statement. And I just basically covered that here, the effective date. In terms of transition methods, common question, right? Well, hey, we have leases in place now. What does that mean? Well, the initial modified retrospective approach they came out with is they said you would have to go back and apply this to the earliest balance sheet shown in your GAAP statement. So if you have comparative statements, you would actually have to go back to 12/31/21 and implement this. However, they came out with a new ASU, which is Accounting Standards Update. And they basically said that you only have to show it in the year of adoption. So you're still able to show comparative statements, 2022 beside 2021, and you're only going to have to show the impact on 12/31/2022. You will be able to leave 12/31/2021 as is. So that was kind of nice. The most recent standard before 842 was the new RevRec standard that I'm sure most on the call were aware of. Our advice was we went back to a lot of single year statements for that first year due to this modified retrospective approach where you had to go back to the earliest year presented, the first year presented, which created a very time consuming analysis. So most chose to go to the single year presentation. That is not going to be the case for 842. You can still show comparative statements and just deal with it in 12/31/2022, year of adoption. So let's talk about some of the differences and similarities. Again, just kind of hitting high level on the basics. So what's changing? At the end of the day, it's bringing operating leases onto the face of the balance sheet. That is the number one largest, biggest change that we're going to be seeing here. Initial direct cost. Under the old 840, it was very loose in what could be capitalized at lease commencement. You could even capitalize internal costs that you incurred with staffing and labor to lease a building. The time spent looking for real estate to lease, that could all be accumulated and capitalized as part of the initial lease if it was capital, right? Operating wouldn't be a problem. Now they look at initial direct cost and they've gotten a little bit more stringent on what can be capitalized, and it's the incremental cost of obtaining a lease. So the two items that immediately come to mind for me and that are frequently talked about are lease commissions and then legal fees to enter into that lease. Those are pretty much the restrictions now for what's going to be capitalized and expensed over the life of that lease. Internal cost now, meaning the cost of your time and your staff's time as it relates to leasing, is just going to be expensed as incurred. You do not have the opportunity to capitalize that. Presentation and disclosure. You're going to see, just like with the 606 disclosures, they, as I like to call it, disclosure bloat. It turned your revenue recognition 2-paragraph disclosure into 3 pages. There's going to be some additional disclosure that comes along with 842 that we're going to have to work through. Now maybe your third of a page, half of a page disclosure might turn into a page and a half. But the disclosure, presentation. So this is, again, this brings potentially several new items onto the face of the balance sheet. You're going to have to break out your operating and your finance leases separately. On the liability side, you're going to have to break out a current and a long-term portion. So that's potentially on the asset side, 2 new assets, right of use asset operating, right of use asset financing. And we're going to look at this later. And then on the liability side, potentially 4 new line items: current operating, current financing, long-term operating, long-term financing. So it is creating a significant presentation change. And again, I have an example towards the end of the presentation. No deferred rent. So a lot of you all with these operating leases, straight line recognition. So, if you had escalating lease costs, lease expense over the life of that lease under old GAAP 840, you would have to recognize that on a straight line method. And the offset there would be you would have this deferred rent on the face of your balance sheet. That all gets wrapped up in the right of use asset and liability under the new standard. So you will not have a separate line item for that deferred rent item. And it is worth noting that still you will recognize rent expense on the straight line method. This standard has no impact on the income statement. And that's something very important to grasp, is that this is strictly a balance sheet change. The income statement recognition, while we'll discover it or we'll discuss it, there are some changes in the way you classify things, but the income statement has 0 impact. You still recognize operating on straight line. You still recognize financing straight line. You basically amortize or depreciate that asset straight line over the life of that asset. And again, we'll cover that. We'll look at that. Similarities, income statement doesn't change, just covered that. Management analysis of renewal options, that's always been a thing. Determining the lease term is very important. And if there's a renewal option, management has to assert to us whether they feel that at the end of the original term, if they will exercise that renewal option. If management believes it is more than reasonable to expect to exercise that renewal option, you will factor that into your lease term when you're calculating your right of use asset and lease liability. And then lease classification, the reason I put that as similar is you still have operating leases, it's just they're coming onto the balance sheet. You still have capital leases, you're just calling them financing now. So it's still very similar, just a terminology change between financing and capital. Let's define a lease now under ASC 842, the new standard. So at the end of the day, it's defined in the standard as a contract that conveys highlighted here, the right to control an identified asset. So what do we mean by right to control? As you look at these bullet points, think about a 3-year vehicle lease, right? So at the end of the day, you obtain substantially all of the economic benefit of the asset. Well, Malloy, one of our local car dealerships, they can't come to you 3 weeks into that vehicle lease and say, hey, I need to actually borrow it for a couple of weeks and take it back from you. No, during that lease term, you are obtaining substantially all of the economic benefit of that asset. So you have the right to control that asset. You direct the use of that asset. You can drive it wherever you want to drive it. And the decision-making over that asset, you can choose who you let drive it. It's not restricted. You have the right to control. Now, that's why I put in here the 4th bullet. Someone might say, well, hold on, there's only a 10,000 mile limit over my 3-year lease. Protective rights of the lessor do not limit control in the eyes of ASC 842. So a protective right does not break this right of control criteria. That would still be considered a lease under 842. Identified asset. So this can be explicit or implicit in the term, in the example of a vehicle. Let's stick with that. When you sign on to that lease, there's a VIN number. Well, that asset has been identified explicitly in that lease. Same with copiers. Typically, these copiers are very expensive machines. There's a serial number associated with them. So you do not have an identified asset, however, if the lessor has a substantive right to substitution, meaning that there's an economic benefit to them if you have an issue with your asset you're leasing, that they have an economic benefit to just swap it out. The example that gets thrown around quite often is your water cooler, your coffee machines. At YHB, we have Keurig machines that's a service contract, right? It is cheaper for the lessor to come in and replace that asset than it is for them to come in with a tech and sit there and dismantle a Keurig machine and figure out how to fix it. We don't have an identified asset at that point. That is a service contract without it is not a lease, it is a service contract. So 842 would not apply. Conversely, you talk about a copier. Well, what happens when you have a copier lease and the thing goes down? They typically don't come out that next day unless it absolutely blows up. They don't come out the next day with a new $40,000 copier and swap it out for you. They typically have technicians. They come out, they try to fix it. It would be too costly for them to just swap them out every time there were an issue. So you still do have an identified asset with the right to control. That is a lease under 842 that will require capitalization. Another important, and I'm sorry for the coughing. I'm just 2 weeks out of COVID and have a residual cough that's lingering, unfortunately. So just bear with me. Lease and non-lease components under 842, something that's called out very specifically in the standard. Very important for us to focus on practical expedience as middle market companies that have a GAAP requirement for a financial statement. Practical expedients are your friend. I'm going to cover several of them throughout this presentation. If there's anything that you really take note of, I would say that, hey, this does apply to you. You're not going to be able to get out of it, which we'll talk about. So look at the practical expedients, make note of them. Lease and non-lease components. Toner cartridges included in a copier contract. The maintenance component of the copier. That is a perceived benefit, a non-lease component that is built in a lot of times into potentially your monthly lease amount. That is considered a non-lease component that needs to be broken out separately from the actual lease of the piece of equipment. Well, Matt, how would we do that? Technically you have to sit down and management has to pull together an analysis of what the maintenance component would be worth out in the market versus the lease component of the actual machine. And then you have to take that same apportionment percentage and apply that to your monthly rental rate. And you're only going to capitalize the actual equipment piece, the lease piece of that allocation. As a practitioner, I think that's crazy. And I'm going to make sure that I have this conversation with my clients, and management has to make the decision, but exercise the practical expedient. It's an accounting policy election. It'll be disclosed in the statements that management has chosen the accounting policy to not break out lease and non-lease components. In that scenario, you're just going to take the monthly lease amount per the lease, and that's what you're going to do your present value calculation on. You're not going to go through this time-consuming allocation. And even if it's not time-consuming, just too many variables. So take note of that practical expedient. Another trap, for lack of a better term, in ASC 842 is this concept of embedded leases. So again, as a practitioner sitting on this side of the table, if I'm sitting here talking to a client, these are the types of questions we're going to be asking this year. And these are going to be part of our built-in inquiries and questions moving forward. Hey, do you have any service contracts? Yeah, we got service contracts. Well, have you evaluated those service contracts to identify if there's any embedded leases within them? Well, Matt, what do you mean embedded lease? Well, a lot of times service contracts can have an identified asset and you have the right to control it. Those are the two criteria that under 842, even if it's under the guise of a service contract, makes it a lease for GAAP financial reporting purposes. Simple example here, cloud storage. A lot of us are doing this, right? I mean, it's the way of the future. Well, if under your cloud service and storage contract, it's probably going to look as if it's a service contract. But if they say, hey, okay, you have server XYZ, okay, they've identified a specific asset. This is your server. And by the way, this is your server in this area of our warehouse. We can't swap you to another one to give this space to someone else. This is your identified space, your identified server. You have the right to direct the use, put on it whatever you want. That's an embedded lease within a service contract. Now, if it says that you get 1 terabyte of storage and that's what you're paying a monthly fee for, if it's that plain English, that simple, that's a service contract. They haven't identified a specific server that you are leasing. They're moving you around to accommodate other clients and other people they're bringing in. You just don't know that they're doing it behind the scene, but you get 1 terabyte of usage. So it's going to be important. We're going to ask the question, be proactive, take a look at these items and be prepared for these questions that they're coming this year. Let's go through 2 quick examples. I'll give everyone, I'm not going to read this word for word, but essentially the example here is you have a company that enters into some copier leases. Under this copier lease, they are required to purchase the consumables from the lessor. So what they're trying to get us trapped into here is to say, oh, well, they're restricting the use because we can only buy consumables from this lessor. Well, that doesn't necessarily restrict your use of the copier. It's just a non-lease component that they're trying to make additional profits off of, right? So that doesn't, I'm giving you the answer here, but that doesn't restrict your use. It's still a lease, at least from what we've read so far. So it goes on to say that there's a maintenance contract. It would be costly for them to replace the copier. It's the same thing that we just talked about. I kind of let the cat out of the bag. But is it a lease? Yes, this is a lease. The asset is identified. You know those copiers are going to have serial numbers. You have those 3 exact copiers. They can't readily substitute those. It's not, there's no economic benefit to them to substitute those. And while they do restrict you on where you can acquire consumables, you have to go to them first. That does not restrict the use. You also may potentially have a lease and non-lease component consideration here. You know, there's maintenance involved. If the consumable right is actually part of the monthly lease consideration, well, you have non-lease components built into this monthly lease fee. You would need to elect that accounting policy election to just have a more simplified basic calculation, or management could choose to go the other direction and break them out. Second example here. So you got some inventory, you ran out of space, and you need to rent 1,000 square foot of a warehouse facility to store your inventory. At the end of the day, the lessor is only guaranteeing you 1,000 square feet. If it is not stating within the lease that it is 1,000 square feet in the north corner of the 2nd floor, or that you go and you view that square footage and that is your space, it will not move. If they have the right to move it around to accommodate other potential tenants, you don't have the right to direct the use of that. You might be able to store what you want to there, but you're not directing the use on a day-to-day basis. And they have a substantive right to substitution. They have an economic benefit to move your space around to accommodate other tenants. We have this a lot in Winchester, Apple storage. If you speak with some of these folks in the Apple storage industry, or just the Apple industry in general, a lot of times they're leasing these large warehouses around Winchester, but there's other orchards that are also using that space. They keep their inventory separate. They know whose inventory is whose, but they're constantly moving that around to accommodate incoming shipments and outgoing shipments. They don't typically have designated lanes. So again, that would be considered a service contract. That would not be considered a lease under 842 that would require capitalization. All right, lease classification. So here we go. So terminology, finance lease. Again, this is your old capital lease. You see these bullet points, they're basically the same as the capital lease criteria used to be. The difference with 842 is they allowed for more judgment to come into play here. Under the old standard, and I'll go ahead and flip to the next slide, we're all used to this flow chart, right? That when it comes down to the lease term is greater than 75% of the economic life. That was a line in the sand under 840, where when you looked at your lease term, if this was a 7-year asset and you were leasing it for 6 years, well, you're leasing it for more than 75% of the economic life. That would be considered a capital lease. Under 842, they did not give us these bright lines in the sand of 75% of life or 90% of the value. However, what are we going to do as accountants, practitioners? We're going to fall back on what we've known, because at the end of the day, that 75% and 90 seem like pretty reasonable metrics, right? So I can tell you now, as an auditor and independent CPA, I'm still going to look at those as at least being the red flag that gets raised that says, hey, it's coming in at 88% of the estimated value. We might need to consider capitalized. They're all going to be capitalized. We might need to consider calling this a finance lease, not an operating lease. It's going to require some more judgment, some more management discussion to truly determine what you call financing versus operating. But as a gauge, I would still use this same flow chart, 75 and 90%. Operating leases, basically everything that's not financing. So you're going to start with the financing criteria. If it doesn't meet the financing criteria, it falls back to operating, same as it's always been. Subleases, you got to go through the same criteria, right? Sublease, you make sure you have an identified asset, the right to control. You go through the financing criteria. If it doesn't meet the finance lease criteria, it falls back to operating lease, and you account for it accordingly. Lease measurement. Let's go through some key terms here. So lease liability, at the end of the day, that's the lessee's obligation to make the lease payments according to the contract. That is the initial onboarding on the liability side of that present value of future cash flow, future rent payment calculation. Right of use asset, it represents the right to use that asset. So that's the asset side of that present value calculation. Initial direct cost, we covered those pretty extensively there earlier on. The two that immediately come to my mind are going to be your commissions and your legal fees. Those are going to be capitalized as part of that right of use asset, and they're going to be amortized over the life of the lease or the term of the lease, or in the case of an operating lease, it's going to be straight line over the term of the lease. But you'll see the calculations are different. Straight line rent recognition, I should say. So economic life, this is something else that they're very black and white on. It is not just the life that you expect to use the asset. It would be the life by one or more users. So for instance, if you have a dozer, Caterpillar dozer, and you're only leasing it for 3 years, but you know that the economic life of that is typically 10, you're going to factor in for that economic life component, that 75% or more of the economic life. You're not just going to look at what you typically would have capitalized it at, because maybe you would only capitalize it for 7 or 8, but for you or more users, it's potentially 10. That is something that management needs to factor into their analysis when you're doing that financing or operating determination. Discount rate. At the end of the day, I keep throwing around present value of future rent payments. Well, as part of a present value calculation, it factors in a discount rate. So the standard states that if it is implicit within the lease, so you actually have the opportunity and you have the information needed to back into what that implied interest rate is, that is what you are required to use. Now, I haven't come across many leases where they're just point blank letting you back into the fact that you're paying 25% interest. Typically, it's very hidden, it's convoluted, it's tough to get back to. So if that's the case, you can fall back to your incremental borrowing rate. A mistake that is often made is people say, oh, my incremental borrowing rate is my line of credit rate. No, it's not. Incremental borrowing rate means what you would have to pay in the market for a similar asset. If vehicles are going for 6.5%, but your line of credit is at 3%, your incremental borrowing rate for a vehicle is 6.5%. Now, practical expedient, make note. A lot of folks, a lot of my clients are probably going to say, Matt, I don't want to get lost in these incremental rate determinations. Let's just use the risk-free rate for all of our lease calculations. Risk-free rate is the rate that you would earn as an investor with zero risk. Well, it is very, very small. You can look it up. It's out there if you type in risk-free rate for 1 year, risk-free rate for 3 year. They're published. The kicker here is the lower your rate, the lower those cash flows are getting discounted, lesser those cash flows are getting discounted. So your initial onboarding of the asset and liability are going to be higher, right? Because it's not getting discounted as much. There's not an implicit interest rate. There is the risk-free rate, but the interest component is going to be at a lesser amount. So that is one thing to factor in, especially with the way it's going to mess with your ratios, which we will look at. Lease term. The lease term is defined as the stated non-cancelable period, plus any renewal options that management believes they will exercise, or if termination options. So again, if you're like, hey, yes, it's a 5-year lease, but we know we're going to terminate at 3 years, well, then you're not going to use a term of 5. You're going to use a term of 3. You're trying to hone in on what the true term of that lease is going to be. Another practical expedient. So a lot of you might be saying, I know there's some contractors on the call. Man, we lease equipment all the time. So if I have a 3-month lease and it crosses year end, I got to deal with this? No, practical expedient. Leases less than 12 months do not fall under 842. It's an accounting policy election. It'll be something that's disclosed in your statements, but we'll be able to get around having to do these convoluted calculations for leases that are less than 12 months. And I already know what some of you savvy ones out there are thinking. Oh, great. Well, I'm just going to make all of my leases month to month or less than 12 months. I hate to tell you, but that's not going to work in all cases. And we'll cover that here in a minute. The lease payment, again, I need to move a little quicker here, but the lease payment at the end of the day, it's when you're looking at the future, the present value calculation of those future payments, you're not just going to want to factor in the fixed payment. You also have to factor in, well, if in the term you factored in a renewal option, and you know that with the renewal, that comes with a 5% escalation in the lease payment. Well, you got to factor that in to your future rent payments that you're discounting back. So you really just have to mirror what's going to happen with your payments based on what you've determined with your term. Early termination, if there's a penalty, well, we got to factor that in. Let's talk accounting here. So let's actually visualize it in an example here that follows. So at the end of the day, for a finance lease, used to be called capital, now financing, income statement is front-end loaded due to the interest expense component. Well, that's the way a finance lease has always been. The right of use asset is amortized on the straight line method. Well, that's the way it's always been. There is no income statement impact as a result of this standard. It is all balance sheet. Finance leases really don't change from what capital used to be. So let's talk operating. So operating, you're going to straight line the aggregate lease expense. You're going to add up what your total lease expense is over the life of the lease, divided by the lease term, and that's what you are going to expense on a year-to-year basis. That doesn't change. That's exactly what 840 was. Again, no income statement impact. For the right of use asset that's going to be brought onto the books, I hate this term, but there's no way around it. The reduction of the right of use asset year over year is more or less a plug, because you still have this present value calculation, which includes a discount, interest expense, for lack of a better term. But under an operating lease, you don't recognize interest expense. You just recognize straight line rent expense. So that interest component goes back and increases the right of use asset on a year-to-year basis. We will visualize this and look at it. This is just a quick diagram. It pretty much goes over what I just covered. And again, when you get these slides, take a look at it. I just tried to create some little cheat sheets like that financing lease criteria. This is another one that could be handy as you're kind of thinking about from year to year the impact. It's just a visual aid. Initial measurement. Again, I beat this up. So your initial measurement is to calculate the present value of future lease payments that is going to establish your right of use asset and lease liability. On the right of use asset side, however, though, if you have initial direct costs such as commissions, legal fees, you will add that to your right of use asset balance that then gets amortized over the term for a finance lease, or as part of the straight line component, straight line recognition of lease expense, aggregate lease expense in the operating example, which we will do an example now. So I'm not going to read it word for word, but essentially we have a 6-year lease, a 3-year renewal. There's an escalating a lease expense every 2 years, and management does not believe that they will exercise the renewal. They've also determined that there's no rate that they can determine within that lease agreement, so they've chosen the incremental borrowing approach with the rate of 4%. Excel is going to be your friend. Excel has these present value and net present value calculations at your disposal. So this 91,000, I'm not going to go through the actual calculation, but again, you'll have this if you want to try to back into it. Also reach out to me. But the present value calculation under this lease for the future rent payments is $91,053. So day 0, lease commencement, you have a right of use asset, and there's no initial direct cost here, so kept it simple. So present value, future cash flows, rent payments, $91,053 that's going to be recorded as a lease liability in a right of use asset. Let's focus on the blue section. Let's go there first. So here's what that looks like over time. So you have an interest, right? You're going to run an amortization schedule, and you're going to have an interest expense component that comes into play here, right? And your payment in year 1 over to the right is $15,000. Well, the lease liability comes down by the $15K, goes up by the interest expense component, right? Because that compounds onto the debt piece. So that goes down by $15,000, but back up by $3,642, arriving at your lease liability balance at the end of year 1, if you did the math. So you have interest expense being recognized on the income statement now. Well, what do you do with your right of use asset? Your right of use asset comes off straight line over the term. So that's $15,176 that goes against the right of use asset and hits amortization expense. And you see over the life, the total amortization expense that's going to be recognized is the $91,053, which equals the right of use asset, taking that right of use asset to 0. And your total expense overall, because you have the interest component, is your $105,000, which is equal to your total cash outlay, right? I mean, it's still accounting at the end of the day. The debits and credits got to add up, but that is how you're going to do it under a finance lease. That is the same it's always been. Again, I know I've said it 100 times, but that's the same as a capital lease was. Flip the script. Let's say if this would have been deemed to be an operating lease. Okay, well, now we don't have, while the interest expense component still plays into the lease liability because of the present value calculation, you don't recognize interest expense. Back to that plug figure, the right of use asset. So let's talk the liability first. Liability went down by the 15 grand, but it went back up by the $3,600 in interest expense, for lack of a better term. So the lease liability balance, if you look at the two, so at the end of year 1, $79,695. Under a finance lease, $79,695. The lease liability is the same under both. It's the right of use asset that comes off differently. So in the scenario here with the lease expense, it is straight line total cash outflows, which were the 105, straight line over the lease term. So whereas on a finance lease, you have the amortization component with the interest that add up to 105. Under the operating, you just have lease expense evenly over the 6 years that adds up to the 105. Now, if you look at total expense year to year, finance lease, back to that front end loading component, because it's an amortization, you have an interest expense component. Year 1 under operating, 17.5. Year 1 under financing, 18,800, right? Front end loaded. but total expense over the life still 105. That's your total cash outlay. So that's kind of a visual, and again, you'll get these slides that kind of visualizes the accounting, at least under finance and operating. Remeasurement. If you have, let's say you get to the end of your initial lease term, and you say, man, we didn't think we were going to renew that thing for 3 years, but we decided that we were. Well, that requires a remeasurement that day, right? So, okay, you can't just go 3 years now without it on the books. We now have to reevaluate this lease and bring a right of use asset and a lease liability back onto the books for that 3-year renewal. The key to remeasurements is you have to reanalyze the discount rate you use, and you have to do it at the current day, current determination, the day that you make that change, that reassessment. You can't say, well, we used the 4% rate originally, so we're going to use that 4% rate 6 years down the road. As we all know, rates are very volatile. So when reassessments occur, the rate is most likely going to change. Last piece here, folks. So presentation and disclosure. Let's bring it home here with what things are going to look like. At the end of the, you know what, I'm running out of time, so I'm going to actually jump here to what the actual presentation and disclosure looks like. So here it is. So the middle column, the left on the comparative, the old standard, ASC 840. The right column, new standard, ASC 842. The blue is going to be indicative of capital financing leases. And the brown for tan, for lack of a better color recognition there, that tan is going to be your operating leases. So in this scenario, this company had some capital leases, right, to the tune of $279,000 that they have now had to break out of that property and equipment line item. Typically, it would have just been buried. We would have been PP&E, including capital leases of X. Well, now it has to come out as its own separate line item as a right of use asset financing. In addition, they had operating leases. So most likely they were leasing, let's say, some real estate, and it was in the back of the footnotes. Well, through the present value calculations, we've now determined that they got to bring a $5.8 million right of use asset for a building lease onto the face of the balance sheet. Now, given these are all long-term, right? So there is no current portion of the asset. So your current assets stay the same. Now, let's flip the script to the liabilities. On the liability side, back to the new accounts that are going to be established, you have to separately state the current and the long-term portion of the liability for both operating and financing. So potentially 4 new accounts, because you can see here there's just some movement here. This one went to 0, it moved up to here. For the financing, it's always been there, but it's a terminology change. So that line item's the same. However, we now have this operating piece where we've now added $5.8 million to the liabilities, part of which is a current portion. So I work primarily in the construction and real estate industry. 2 key ratios, number 1 key ratio, net working capital. Well, what did this do to net working capital? Current assets less current liabilities. So your current assets here, 15.5, no change, right? But you come to the current liabilities, you just had, you know, $600,000, $600,000 decrease in your net working capital overnight for doing nothing different than you've always done. This is where I want to stress the importance of getting out ahead of it. I know we have a great group on the phone today. Some credit analysts are on the phone today, which I really appreciate, because the banking industry, the surety industry, don't just expect them. Don't sit back and expect that they know that this is coming. And if you have a significant lease portfolio, you send them your year-end statement, and then you find that you're backing yourself out of a corner because they come back and say, well, your net working capital went down $2 million. So we got to reduce your bonding capacity by $20 million. Or, you know, again, I'm getting construction specific, but that is key. The other ratio that is applicable to all entities, not just contractors, and I would argue net working capital is, but debt to equity. because you notice here, no income statement impact. So you're not getting any equity impact. However, your total liabilities down there towards the bottom, your total liabilities just went up $6 million. Your equity didn't change. So what does that do to your debt to equity ratio? It deteriorates your debt to equity ratio. Now, what I would anticipate is that we're going to find that the credit industry factors these things into their calculations, and we find that they're potentially doing add backs and adjustments as a result of the operating lease component. Maybe not the financing because it's always been there, but at least the operating lease. But again, don't assume, get out ahead of it, especially if you have a strong financing background in your organization or a surety need. To the income statement, again, you'll see no change other than some presentation change. But at the end of the day, your net income is the same. Your net income does not change. I know I've said it 100 times. So closing points here, I'll throw the camera back on. Not going to have time for Q&A. I'm sorry. Please reach out to me. But a few Mythbusters here. So I'm sure a lot of folks have been saying, oh, great. My real estate lease is with my related party. It's a leasing entity under common control that we don't consolidate. So I'll be able to just have them change it to a month-to-month lease and get around this. Potentially works. However, it does not work. What it's going to come down to is, are there other factors that make that an implicit lease term more than month-to-month? Is there cross guarantees of debt? Well, if the operating entity guarantees the debt of that leasing entity and there's still 10 years left on the note, you're going to have a 10-year term no matter what you're trying to do with your lease to get around the leasing standard. However, if you come out and approach it in a manner of, well, hey, I'm going to make sure that I establish a 3-year lease with no renewal options because I have the ability to negotiate that. Well, that's going to be a little bit of a different story then, because who knows what's going to happen down the road. And a 3-year term is reasonable. We get to the end of the 3 and maybe you say, hey, okay, we win another 3. Well, then we recapitalize again at 3. So just be careful with trying to find loopholes. Reach out to your advisor, reach out to your independent CPA. They'll be reaching out to you. Jake, Dory, myself, Jessica, the construction crew here, for any contractors on the phone, will be reaching out. We got to start having these conversations. So the month-to-month, the lease workaround might not work. Also, not all leases now are financing. There's still a difference. They're still operating and financing. The accounting's different. The disclosure's different. And we'll be helping you through that. How to prepare. I'm not going to cover all this. Hit the high points. Be prepared for your independent practitioner, your independent CPA to come out. Sit down and take a look at your lease schedule. Start pulling all those inputs together. Let's sit down and have conversations before the end of the year comes. And at the end of the day, just be proactive, not reactive. Let's get this out of the way in the fall. That way everyone's not worried about it there at the end of the year around the holidays. We're here to help you. And that's it. So I want to thank everyone for your time today. Hopefully you enjoyed some kind of good lunch. I'll go eat now. And Danita, I really appreciate you in the chamber hosting and giving us this platform to share this information. So thank you.
Thank you so much, Matt Smith. And we put the information for Matthew in the chat if you would like to copy and paste that. If you need any more information, please reach out. We thank you so much, and we hope you have a great day today at the top of Virginia.